We're lucky to have a few unicorns. Jeeves is one. The last round valued them at $2.1 billion. We were their first investor. And then there was Zepto. We were in their first round. It's raised at a $5 billion valuation. I ended up being the first employee at this startup. I ended up going public in 2016 and are worth $2, $3, $4 billion. The founder of Instagram was a fraternity brother of mine in Stanford. And I remember he was trying to raise some money. I could have like 5K or something like that. But I wasn't investing at that time. I've invested in a lot of my classmates, and a lot of our classmates are investors in us. People like to think that if anyone can build a $1 billion company if they just have the right idea. I don't think that's actually true. The successful startups and the failed startups do not look very different on the inside. They both look like total shit shows.
Today, we're joined by Peter Livingston. Peter founded Unpopular Ventures, a rolling fund and angel syndicate that's deployed over $70 million into more than 430 startups globally. Let's get stuck in.
But just before we do, let me introduce this week's sponsor of the OpenVC Podcast, Intercom.com. Intercom help founders by making your customer service 24/7. Through their use of innovative AI, you can answer 50% of your customer needs instantly. Intercom is offering 1 year free if you use the code OpenVC, all in caps, at the checkout, using the link in the description below. And let's get back to the episode. Peter, I'd like to take you back all the way when you graduated Stanford, and you found yourself joining a really novel, innovative hardware company.
It's a company called iRhythm. It's a medical device company. We develop devices for diagnosing cardiac arrhythmias. It was very lucky that I found my way there. I was graduating from college. I really wanted to work for a startup. I grew up in the Bay Area and just kind of knew friends and friends of friends that were VCs and said, hey, I'm looking for a startup to join, any startup. I worked at General Motors the summer before, really didn't like the whole corporate thing. A VC that I knew responded and said, we just seeded this one company with $3 million. They're looking for their first engineers. In particular, they needed someone who could create 3D renderings of the product that they wanted to make. And I'd been working part-time during college as a CAD draftsman, basically creating 3D renderings, and I'd gotten pretty good at it. And I created a model of their thing, and they're like, wow, this is amazing, and they hired me. And so somehow I ended up being the first employee at this startup, and I just got very lucky. They ended up going public in 2016 and are worth $2, $3, $4 billion. It fluctuates. I haven't looked recently, but it's a public company worth billions now. So somehow that one worked out.
You're very humble, but there aren't too many grads that end up picking such a rocket ship that IPOs for several billions of dollars. So I think you kind of gave us a bit of a hint as to how you de-risked it somewhat, which was listening to professional investors and seeing what they thought was hot and where your skill set would actually add significant value. So for graduates, leaving education now, looking for opportunities in the startup world, is that something you'd recommend they do to de-risk it? Because they're probably inundated with lots of offers, some nice safe offers from big techs with some comfy salaries. How would you go about advising people picking where they can learn the most?
I mean, thanks for your kind words, but I really, truly believe there is so much luck involved in this. Okay. Sure, I was able to find a startup through that VC, but without naming names, that VC's portfolio that this company was in, last I heard, was a total disaster, only returned like 0.4x or something like that. So, it wasn't necessarily, I could have gone to any other company in that portfolio and might not have worked out. Somehow I got lucky with that one. I've had lots of other startups that I either founded, invested in, or worked with that were complete failures. And I think the nature of this is, startups are great in that you learn a lot. There is high potential for upside. I think it's really fun to be able to when you work at a big corporate, you're a small cog in the wheel. You don't own very much. You don't have much of an impact. And the cool thing about startups is that everyone really has to go above and beyond, and you end up kind of owning and doing a lot more than you would be able to do in that bigger company. I got lucky with that one, but I'm not always so lucky.
Understood. Okay. On this show, I'm quite careful to not just glorify successes. So I'm sure there must have been some tough days at iRhythm. Is there anything in particular that sticks out in your memory of a tough day that the team overcame, or just something you're incredibly proud of your time there?
Well, I think I'll share one of my biggest learnings from both having been through that and also being in a failed startup. When they're going, the successful startups and the failed startups do not look very different on the inside. They both look like total shit shows. And what I distinctly remember from iRhythm is it constantly felt like things were going wrong. The products weren't working. We were getting delayed. We're almost running out of money. There was huge team turnover. The people getting fired, the CEO getting replaced, the founder kind of getting sort of pushed out for a while, coming back, kind of getting pushed out again. Not fully out, but sort of pushed to the side. And there was just always this internal fighting and politicking. And yeah, at multiple points, I remember talking to friends or my parents. I was like, gosh, I'm not sure this company's going to work out. Everything's going wrong. And talking to another VC in the company after it was successful, and I remember her telling me oh yeah, we thought that company was toast multiple times, and we didn't think they were going to be able to raise more money to stay alive, and somehow they did. And so yeah, my big takeaway from that successful one is really, you never know until it's over. It's such a roller coaster, and even in the companies that are ultimately successful, there are multiple points along the way where maybe they stumble. Maybe the growth is slow, things don't happen as fast as you'd expect, and maybe you think it's even going to die. Many do, but somehow some of them end up being successful, even though you can't really tell along the way. So that was my biggest learning from that. And I see it now with our investing. We're invested in so many companies where it's very rare for things to just go up and to the right. In a lot of our most successful companies, we weren't sure at various points along the way. And then I get an update 3 or 6 months later, and it's whoa, all of a sudden they got the customers or raised the money, or all of a sudden it's wow, now they're doing great. And so you really never know along the way. It's just manage through chaos, through the roller coaster of ups and downs, and sometimes it works out.
I think that's a really good insight. Thank you for sharing that. Outsiders might look at the startups that are having great successes, but actually they're just overcoming as many failures as everyone else. It's just resilience and, well, a lot of innovation that help people get to the finish line in a hyper uncertain environment. So after the success iRhythm, you went back to business school, back to Stanford. You were already an operator by that time, and you'd been through the ups and downs. Why do you think that positioned you well for your future career?
I had long known I wanted to do business school. I'd done engineering for undergrad. I felt okay, I can build. I want to kind of understand the business side of all this, the finance, the sales, the marketing, and all that. And pretty much everybody I respect says the same thing. You don't go to business school for the learning. You can learn the content anywhere. You go for the credential, kind of the branding, and you go for the network. And that is what I got out of it. So the really awesome part of it for me was just all the amazing people I met. I'm still friends with so many of these people. And in fact, I've invested in a lot of my classmates, and a lot of our classmates are investors in us.
I want to tuck into some of the network that you've built at Stanford, and it plays into some of your perhaps most exciting anti-portfolio companies with some close connections to Instagram and DoorDash. Would you be able to tell us how close you were to those and why they weren't good investments at the time?
No, they were great investments, but I was just not smart enough to see it. So I can actually talk about 3 huge anti-portfolio misses. So Instagram, DoorDash, and Newbank. So the first, it was Instagram. So the founder of Instagram, Kevin Systrom, was a fraternity brother of mine in Stanford undergrad. I was friends with him after college. He and I actually worked in the same building when I was at iRhythm. He and I got lunch a couple times. And he had kind of gone through these startups, worked at Google in an impressive role for his age, and then was starting this startup called Bourbon. And I remember hearing that he was starting this thing and was trying to raise some money. And I kind of heard through another fraternity brother who's thinking about investing or not. And I could have easily reached out to him and said, hey, can I put in $5K or something like that? But I wasn't investing at that time. And I thought, I downloaded the app. I was like, it seems kind of stupid. Okay, whatever. And then a few months later, they pivoted from Bourbon into Instagram, changed the product a little bit. And then within 18 months, they got bought for $1 billion by Facebook. And that was my first big wake-up call where I was like, wait a second. I do know these smart people that are starting these companies. I need to start investing small amounts of money in them. And so that was actually the main inspiration that led me to start angel investing a little bit. So that was the first anti-portfolio. But yeah, I wouldn't have invested because I wasn't even investing. I didn't even know how to think about it.
I believe the people that led the first round in Bourbon, they actually passed on the second opportunity to invest because the pivot resulted in it clashing with another portfolio company, and he was actually the second mover into that space. I think that was A16Z. I might have had that wrong, but
I think you may be right about that. Yeah, no, it's crazy. The other big learning from just that is most startups actually pivot. So I both saw it there, but then have also read from smart people that about 95% of companies that are ultimately successful are successful with a different idea than they started with. And so if that's the case and you're investing early, you can't judge ideas too much. You really just have to bet on people that have maybe a record of success, or maybe kind of know the space they're operating in, have an insight about a market. and just assume that they're going to go out there and change what they're doing multiple times. And so yeah, at the early stage, all you can bet on is the people.
That makes a lot of sense. So that was Instagram.
So then the next two misses were DoorDash and Newbank, which were both very good friends of mine from 2 different years of business school. So I'd gone to the first year of business school, it was class of 2012. David Velez, who founded Newbank, which is now worth like $70 billion, was a very good friend. He and I hung out a lot, partied together. And I was investing at that time. I was inside of Kleiner Perkins, and he was a partner at Sequoia. He and I would get lunch every now and then and talk startups. And then I just heard that he was going to do something in Brazil with like a credit card. And I was like, Brazil, that sounds like sketchy and risky. And again, I could have easily reached out, but it sounded like a bad idea to me. And it sounded very risky. I was like, not worth it. I heard that he actually didn't let friends invest, so maybe I still wouldn't have been able to. But maybe if I had tried, maybe I could have gotten in. I don't know. But still, it was a case where it was like, again, just bet on the smart people. He was a very smart guy, had a great track record, was a partner at Sequoia focusing on Latin America. Like, God, I should have just reached out and said, let me put in a little bit of money betting on him. So another huge miss for me. And then the other one, so I had left business school for a year to do the startup Life Square. Didn't work out, came back and finished. So I was then in class of 2013. I was a co-president of the Venture Capital Club with the 2 founders who went on to do DoorDash. And in that case, once again, I was talking with my good friend Evan Moore. He said he was doing a startup in food delivery. I thought, food delivery, that's not very sexy. It's a low margin business. I shouldn't even check it out. And once again, I knew he was a really smart guy. And he and Tony Xu, I should have just bet on the people. But again, I judged the idea and I was like, that doesn't sound that great. And I didn't investigate it further. And man, those 3 together, I realized, you know what? I need to stop trying to overthink this and just invest in every smart person that I know. So that was it.
Well, hindsight's a wonderful thing. I mean, you're here today because I found you from your great successes that you've had at the Unpopular Ventures, which is both an angel syndicate and a rolling fund. To date, you've invested over $70 million into 400 plus startups, and it's been phenomenal. I think your 2019 and 2020 funds are worth 5 times and 7.5 times in the invested capital already, which is just outrageous.
It has come down a little bit, but it's now like 4, 4.7, and I think like 6 and change now. Like with the downturns, so we've had some markdowns, so it's a little bit down. But no, we're very fortunate to be doing that.
Even with the little bit of a haircut, that puts you well into the top, probably 1% of all venture returns for that era. Could you tell the audience a little bit more about your thesis at Unpopular and what keeps you different from the rest of venture capital?
Yeah, so it comes from a lot of different experiences I've had. So I talked already about, just invest in good people, regardless of what they're doing. And in fact, a lot of the best ventures sound like dumb ideas in the beginning or seem risky. I worked as a professional angel for about 5 years, invested in a lot of different things. And one of my insights from that time is that the best investments I did were the ones that I would share with other people, and I couldn't get them to do it. So once again, these things that seem like really non-consensus or risky or out there to most people ended up being the best ones. And a big one from that was just crypto in 2015. I went down that rabbit hole, did a lot of research, felt very high conviction, put a big chunk of my fund into the main things at that time, ended up with an extremely high multiple fund that was liquid. I realized from that many of the best investments are very unpopular in the beginning. And I realized also it's not just investing, and it's not just startups, it's really all life decisions. If you do what everybody else does, you get what everybody else gets. And I've just really found that all the decisions in my life that I've been most happy with were often the least consensus. And so we named our firm Unpopular Ventures. And the intent was to go invest in really good people doing things that are a little bit non-consensus or off the beaten path, a little bit unpopular. And we are often wrong, but when we're right, we're very right. We've been able to invest in some really fantastic founders building really important startups, and many are well on their way to being very successful.
How do you go about making these investment decisions? So you're inundated with deal flow. You source it from all corners of the world. What stands out to you, which probably wouldn't stand out for the next VC fund?
So it depends on the stage. So we invest at a few different stages. We invest very early at kind of a founder and an idea stage. We often invest later where maybe they've made some progress and have some traction. So it's me and one partner who's been with me since almost the beginning, Thibaut Reichel, who's been fantastic. And he and I have slightly different approaches, and we invest in slightly different things. It's very complementary. We index very heavily on founders' backgrounds. In general, we want to see a track record of success. And that can be defined in many ways. On the one hand, yeah, we do end up investing in a lot of Stanford people. It's an indication that, we're pretty smart or we're able to accomplish some good things. But we don't only invest in that. There are many other markers of success. Maybe they led a team and launched an important product at a big company, or maybe they played a critical role in a startup that did well, or maybe they founded something themselves before. But in general, this is an insight I took from those 3 anti-portfolio companies. Almost nobody goes out and founds a $10 billion company out of nowhere. People like to think that if anyone can build a $1 billion company if they just have the right idea. An unfortunate truth that I'll share is I don't think that's actually true. In every single case of someone founding one of these multi-billion dollar companies, if you really dig into the founder's background, they had some sort of track record of amazing things that they did before that. Like there were hints that they were actually very smart and were going to go on to do great things. And an example there I'd like to share is people think Mark Zuckerberg founded Facebook when he was in college. Clearly, he came from almost nothing and he built this massively successful company. But no, there were actually signals that he was really exceptional from very early on. He had been launching various projects when he was at Harvard. There was this hot or not thing that he created that went super viral. Clearly, he knew how to build things on his own and he knew how to make them go viral. And I think now if I were to see a kid like that building these things and actually launching them pretty successfully, I'd be like, that guy's probably going to be successful later. So that's what I look for. It's hints from the person's background that they're sort of destined for success. And it's not that they can't have ever failed. I've failed many times, but I do want to see that kind of aspiration for greatness and trying it over and over again, and sometimes getting lucky or making it work. So that's number one on team. I'll pause there. Any questions before I talk about maybe other things that we look for?
Well, what I was going to say is you seem to be able to build extremely high conviction on founders, especially at the early stage, because you were the first fund to invest external capital into an Algerian startup, which is quite risky in terms of what the legal landscape might be, how it was received, what kind of shareholder powers you might have if things were to go wrong.
We do have a lot of other places all over the world, all over Latin America, throughout Africa. We are in Nigeria, India, Pakistan.
How are you able to invest into these regions that might put off or deter other VC funds?
Yeah, so once again, we index very heavily on the founders. And again, we don't go find a random guy in Algeria who has an idea and give him money. We look for a track record of success. And so in the case of the Algerian company, a company called Yassir, they started as kind of the Uber of Algeria and have now expanded to be kind of a super app for all of Francophone Africa, French-speaking Africa. And the founder was just extremely impressive. So actually my partner Thibaut brought this in, and then it was the first investment he led for us here at Unpopular Ventures. And so the founder was a Stanford PhD, had been an executive at Intel for several years in Silicon Valley, and then put $1 million of his own money into this to get it off the ground. And then with that $1 million, he was able to achieve extraordinary traction in the business. They had something like 20 million of annual sales, growing very quickly, and they were raising on a $15 million pre-money valuation because nobody would give them money. And this is the funny thing about VC. Most VCs draw these very strict boundaries about what they will or will not invest in. Most would say, okay, we're only going to invest in the US or within 20 minutes of home, or we're only going to invest in biotech or in SaaS companies. So it's they create these boundaries. And then even if a really compelling founder or opportunity comes along, if it's outside those boundaries, they just instantly say no. And that's kind of what we want to break. And so there's an exceptional opportunity, exceptional founder, exceptional traction, high market potential, but it was out of bounds for most. And so because of that, we're able to invest in what we thought was a great opportunity. Turns out so far it has been, and almost nobody else was willing to invest in it.
And was it a case that it was too good an opportunity to pass up, that all the risks that came with investing in Algeria, putting money out there, the legal potential downfalls just didn't matter? It was just the upside was so great that it was risk adjusted, it still made sense. Or did you do things to mitigate what could have gone wrong?
Yeah, it's a great question. So this is another thing that we really think about. So the size of your portfolio has a big impact on how much risk you can take. So a lot of VCs will make 1 or 2 investments per year. And when that's the case, they really want to make sure most of their investments work out. They're not willing to take very much risk. So at that time, we did about 24 investments that year, and we now scaled it up to about 150 investments per year. And when you do that many investments, the risk calculus really changes. So, for example, if you see a company where you think maybe there's a 1% chance it could return 1,000x and a 99% chance of zero, that's your one investment of the year. Or maybe even you're going to do 10 investments that year, you're probably still not going to do it, even though the expected value of that is 10x. That's a great expected value, even though you're going to be wrong 99% of the time. If you have a portfolio of 100 companies or 150 companies, then, whoa, I would love to make 100 investments where each one has a 1% chance of making 1,000x, 99% chance of zero. I mean, that produce amazing portfolios over and over again. And so we take more risk than most VCs, and we are wrong a lot. We're wrong more often than most VCs, I think. But we get into these extreme outliers more often, just because we accept these higher beta, higher risk dynamics.
No, that makes a lot of sense. You understand all the returns are generated by the outliers, so you've got to buy a lottery ticket and give those guys a chance. And so spreading bets by making 100, 150 a year, you are reasonably increasing your chances of building a portfolio that generate healthy returns. But how do you handle being sector agnostic over being a sector specialist? Because a lot of VCs talk about, oh, we build great portfolios because we add so much value, we know all the connections in the space, we can help introduce you to X, Y, and Z. But if you're being sector agnostic and you're investing all over the globe, I imagine that's quite a hard thing to do.
Yeah, so there's a couple of things about this. So the first is it ties back to we don't really bet on ideas very much. We bet on people. And it's relatively easy to assess people based on kind of the track record of what they've done. And yeah, it's funny. I personally believe even if we were experts in some area, I don't know if that expertise really helps you judge what the next great startup in that area is going to be. In fact, it can often be blinding. You kind of know what has worked and you're kind of not as open to alternative ways of doing things. So that's the first thing. Then on value add, we actually are pretty helpful. We have a big network of other VCs, so we're actually pretty helpful for introducing companies to other investors across different stages. We're just trying to invest in great people, building high potential businesses at ideally pretty good valuations, and we do not lose deals very often. We didn't get to invest as much in Zepto as we would have liked. It's a company in India that's now worth $5 billion during the first round, but only got to invest $25K. We got pushed out maybe because we didn't have as big of a brand as the others. But aside from that, for the most part, we can invest almost as much as we want in probably 80% of companies we want to invest in.
For the founders listening, what kind of ticket sizes do you do, and does it differ between the rolling fund and the syndicate?
Yeah, so we have both this rolling fund. It's about $5.5 million a year. We make a lot of investments from that. Most of them are 25 to 50K, sometimes 100K. And then we also lead one of the biggest syndicates on AngelList. We have about 5,000 LPs who follow us there. When we engage that big kind of group of investors that we have, then we can write much bigger checks, almost always at least 100K, sometimes as much as $500,000, and occasionally we get even $1 million from them. Through these two vehicles, both our fund and our syndicate, kind of our check size range is 25K to $1 million.
Awesome. I'd love to hear about some of the biggest wins you've had in the portfolio to date. I've heard you talk about Jeeves before, and the story behind that's really interesting. Would you be willing to share that with us?
Yeah, happy to share. So we're very lucky to already have a few unicorns, as they're called. So Jeeves is one. They've built kind of a global business bank focused on fast-growing companies that operate across borders. And that has historically been very challenging if you have bank accounts and expenses and income in all these different countries and managing the different currencies and the banking regulations and how you account for that and how you move money between them. And they've created basically infrastructure that makes that all easy. And they've done really well. So the last round valued them at $2.1 billion. They've got a fantastic team. They've got a lot of revenue and are growing. So we continue to be very bullish on them. So we were actually their first investor besides Y Combinator, and the biggest investor in the first two rounds. That one I found, fortunately, it was a good friend of mine, classmate from business school. I did not have expertise. Yeah, a ton. I actually did have a little bit of expertise, but not a ton. But after having missed so many friends and classmates, I was in a mode of kind of always investing in my friends and classmates that I thought were smart. And that's why we did it and did it so much when we did. So that was a big one. Yassir, we mentioned, that's also a big one. We led their seed round. We're the first outside investor, and they have a ton of revenue. I can't disclose, but there's a big new round in the works. I can't comment too much, but anyway, they've raised a lot of money. They're doing extremely well. And then another one is Zepto, an instant grocery delivery company in India. We're in their first round. We just raised at a $5 billion valuation with a tremendous amount of revenue, growing like crazy. We really think they could end up being one of the most valuable companies in India over the coming years. So,
wow.
And we have a lot of others that are doing great, but a lot of them are being very stealthy. So actually, probably our single best investment, I'm not allowed to talk about publicly.
Maybe next year if we could have you back on and could come out of stealth mode. Okay, so you had some big wins, big bets. Oh, I was going to follow on with something before going into when it goes wrong. Escape me. Okay, so we touched on the successes. Are there any examples of when making these contrarian outlier bets abroad in particular, where they have gone slightly wrong? I think I remember hearing about KeyCap and your experience with the Colombian government with that one. Would you mind sharing a little bit of what happened there?
Well, that's actually a funny one. They're doing great now, actually. So it's yet another case of the roller coaster. These companies go through ups and downs, you leave them for dead, and then somehow they miraculously emerge again. And so PCAP is actually doing great. They have multiple businesses. Their main one is a motorcycle ride-hailing in Colombia, and they have a delivery business in Mexico. But anyway, they've done great. To answer the bigger question, do we have ones that things have gone wrong? Absolutely. I mean, the default outcome for most startups is they don't work out. So we have lots that haven't worked out, and it's very sad. It sucks. I wish that all of our founders could be really successful and make tons of money, but that's the nature of this. And I guess financially for us, we expect that most of them aren't going to work out. We're going to lose money or get a tiny return back. And really the way we invest is we expect 1 or 2 per year, maybe 3 will drive almost all the returns. And out of everything we do over a 5 or 10 year period, it's probably going to be like 5 companies, and maybe even less that drive the returns of the whole portfolio. An example here that I love sharing is in Chris Sacca's lowercase capital fund 1, which is widely considered the best performing venture fund of all time. They returned 250x net to their LPs. They had a lot of big wins. They had Uber and Instagram and I think Docker. Twitter might have even been in there. Anyway, he has like all these like really successful investments in that fund. But despite having all those big winners, there's still only one investment that is worth more than everything else combined, and it's Uber. And it's just the nature of this, where it's called the power law nature of kind of venture outcomes, where a success can be a 10x, it can be a 100x, it can be a 1000x, it can even be a 10,000x, and you don't really like 100x or even 500x sounds great, but then if you have another company that did 10,000x, like that's the only one in the portfolio that actually really even matters, even if the other ones are very successful. And we're already starting to see that in our portfolio as well. We have companies in each of our vintages that are like, already starting to be worth more than everything else combined, or close to it.
On a rocket ship, and it's growing phenomenally well, and you could post the whole fund returns just through that one investment. How do you start thinking about an exit strategy, the holding periods, and future fundraising rounds?
So I'm a big believer in compounding growth, and it's extremely rare, or maybe even impossible, for you to create this like super important, super valuable company in only a couple of years or even 5 years. Everything great takes at least 10 years or really probably more like 20 years. And so, the math example that I like to give is, let's say you're lucky enough to get in on an investment that doubles in value net to you every year. So, double. So in year 1, you're at a 2x, then 4x. At year 5, you're at 32x, which sounds amazing. So if you were given a buyout opportunity at year 5 to make 32x, most people would say, wow, that's a great win. They take it. I got a 32x on this investment. You feel great. But what if that company keeps doubling for another 5 years? If it does, you end up with 1,024x. So by selling at year 5 instead of year 10, you literally left 97% of the returns on the table. All those returns, like even the difference between year 9 and year 10 is 50%. So all the most value in kind of a compounding growth curve comes in the latest years. When that's the case, you really want to try to hold these things as long as you possibly can. I remember reading about how in the case of NVIDIA, 2 of the Sequoia partners who led the company's seed round back in I think it was like the 1980s or maybe it was either 80s or 90s, are still major holders of their stock to this day. Like each of them sold like a few $1 million and have held the rest for over 30 years. And now their positions are worth like either high hundreds of millions or billions. Somehow they held on to these shares for a really long time, and now it's one of the most valuable companies in the world. And I remember reading that and like, wow, like that's what I want to do in my life. I want to find a couple of great investments and just hold them forever. Just to finish that thought. So same thing for Warren Buffett. Like Warren Buffett is considered the best investor of all time. But if you actually look at it, pretty much all of his returns came from like 5 investments he did or something like that. Your really good ones compound and compound and compound. You don't really know which ones they're going to be up front. But the way to do really well as an investor is to just hang on to your winners for as long as you possibly can. That's how you make the big money. So yeah, so to tie that up for me personally, I want to actually hold our investments as long as I can. At some point, I'll need more liquidity. I'll probably have to sell parts of them, but I want to hold as long as I can. Our investors obviously will want liquidity at some point. So at the point that either the company's IPO or we get some other liquidity event, obviously we're going to distribute to them. But in that process, they get their shares or their cash. I'll earn carried interest on that. I intend to take that as shares and continue holding them as long as I can. I'm really a buy and hold type investor.
You believe in them on day one, your conviction stayed there, and once they've proven that they're going to be a rocket ship, keep compounding, it becomes quite expensive to take money off the table. But some LPs will want that liquidity. So what kind of holding period do you currently have people in the rolling fund?
So we tell them it's probably going to be 10 years until you get a big amount of liquidity.
So you developed high conviction on founders, and you believe that exceptional founders, the ones that are going to build unicorn companies in the future, have been showing signs of genius or product development and innovation before they actually go and create that final product that becomes a home run. What kind of things are you doing to find these founders, or are they finding you?
Yeah, so the kind of thing that we innovated on a little bit in our model is that we made it known to all of our LPs and portfolio founders that if they send us an investment that we do, we give them a big chunk of the carry in that investment. And with the nature of AngelList, where we have a syndicate with 5,000 LPs who follow us there, that creates a lot of potential scouts, for lack of a better term. Sequoia invented the scout program idea where they kind of bring in people, give them some money to invest, and they get some economics in it. But they can only have like 100 or maybe 200 scouts. And we realized, well, why can't we just open that up to anybody? Why can't we have 5,000 scouts, but we only pay them when they actually send us a deal that we like? And so that's what we did. And so through that, we're able to see stuff from, our LPs are all over the world. And now we also have 440 portfolio founders all over the world. And they too know that if they send us something we do, they get effectively an angel investment in that company. And so that's been really helpful for kind of expanding our reach, allowing just me and my partner, only 2 of us, to see a lot of really high quality companies all over the world. And there's just kind of a screening element to it too, where these people are only going to send us something that, it's either a friend that they know really well or someone they think is really smart. And it's basically vetted to some degree before it even reaches us.
Do you pay that referral commission cash straight up upon making the investment, or are they forced to ride the investment with you?
No, it's carried interest, and so that further aligns incentives. So they have to think it's a good investment to send it to us, because they're only going to make money if it turns out to be a good investment.
That makes complete sense. I'm trying to do a similar thing for our UK syndicate. But yeah, a lot of people want that initial cash up front, and that says a lot if you don't believe in it enough, or you don't think that initial referral fee could 10x. Why would you not want the carried interest instead? In terms of deal flow then, how many deals do you think you screen annually in terms of getting to the 150 investments that you make?
So we're than other VCs, I think. So a lot of VCs like to put up these numbers, say, oh, we read 10,000 decks, and we then talked to this many, and then we met with this many again, and then we did due diligence on this many, and then we invested in this number. And we actually think that sort of those are vanity metrics. Like they really like to say, oh, we're so selective, we saw so many things. But the reality is the vast majority of the companies they're probably looking at are not good investments. If I really wanted to count all that, I probably get like 20 or 30 cold emails a day from founders. And I used to try to read those and try to invest in them, and I quickly realized it wasn't worth my time. And so instead, we've kind of used this model of both referrals, and then we actually do some outbound, like with Y Combinator, we reach out cold to those companies and find good investments that way. But because of how filtered our the deal flow is that we actually look at, we probably don't actually consider that many relative to how many we invest in. I would guess that, like, of the good referrals that I receive, I probably invest in about a quarter of them.
Wow. So definitely quality over quantity here. As you're trying to pick out which investments that you're developing, which investments that you want to invest in, what kind of things do you do now in terms of due diligence and checks that you didn't initially do? So how can we learn from your experience?
Well, due diligence is important. You want to make sure that you're not encountering fraud, stuff like that. But I'm also a big believer that you can't due diligence a bad investment into a good investment. And so no amount of due diligence is going to make you successful. And with kind of the way that we invest, we can see what we like on the surface pretty quickly. And then it's also pretty quick to kind of verify that what we see is actually true. And so the truth is we don't actually spend that much time in kind of extensive due diligence.
Do you make client calls, things like that? Or it's more trusting the founders, being honest with the questions and the
trusting
answers?
founders.
Okay.
Yep. Trusting founders, kind of looking at the network that they came from, who the referrer was, cross-referencing kind of digitally on a lot of these things. So if they're claiming traction, usually there are kind of digital footprints that sort of support that traction. If there isn't, then we'll ask for more. And in terms of background, given that a lot of these are coming in as referrals, like it's usually somebody that works with them, where it's like, okay, their work experience is real, or they actually did do the things that they claim they did.
Have you created a formal sort of weighting structure of things you look for in founders? Are there certain attributes that you think are really, really important that maybe if one founder doesn't have, they have to make up for by being exceptional in other areas?
No, we don't have any sort of formula.
Awesome. Wow. Your partner, Tibu, who's based in Dubai, I think. How did you guys meet? And how do you guys manage the fund together, being thousands of miles apart in totally different time zones?
Yeah, we work really well together. We met through AngelList originally. So he works for a family office in Kuwait where they wanted to get some more venture capital exposure. So he invested for them across AngelList in basically syndicate deals. And he just has incredible judgment. So he was able to pick out many of my best investments. So I was first syndicating deals on AngelList. He was able to pick out some of my best ones that I did through there. And then he sent me Yasir. He sent that to me. He said, I'm going to invest in this personally. Do you want to try to syndicate it together? So yeah, that worked out really well. And then we just started doing more deals together. And yeah, I mean, it's funny. We like a lot of the same things. We have a very similar mindset. He has some attributes that are really complementary to mine. He's very good at processing huge amounts of data. So one thing he does is he goes through the Y Combinator list of companies every year that has like 300 or 400 companies, and is able to go through every single one, read the pages, cross-reference LinkedIn, and form like a really astute judgment about every single one, and then reach out to the ones he likes, talk to all of them, and then make like really good decisions about which ones to invest in. And it's funny, I try to do that. I try to go through these Y Combinator lists. I get through about 10 companies, and it's just like my eyes glaze over. I can't do it anymore. And so he's just so good at sort of like looking at a lot of stuff, not zoning out, and keeping this like sharp judgment. And so like, anyway, he's able to pick out really fantastic companies. He's done really well. Out of our 3 unicorns, two of them are his. So anyway, he's been just a fantastic partner to work with. There's a gradual process to work together. Now we're full partners. And how we manage the distance. So it's funny. We communicate async almost all the time. We text on WhatsApp, email. We communicate several times a day. But it's funny. We actually don't talk live very often. It's probably like once every few months, maybe once every 6 months. We both really trust each other's judgment. We both have full autonomy to kind of make investment decisions. And we talk about it afterwards and kind of share insights and thoughts. But we're both kind of very autonomous and fast, and we work really well together.
Wow. Well, you've been doing this for a few years, so you found a way to optimize the process. And you just hit on my next question, which was going to be, how quickly can you move? And does one of you have a veto over an investment that the other partner wants to make?
No veto. Part of why that works really well is we do have this big portfolio, and a lot of them are small checks. You know, oftentimes if we're thinking about doing a bigger investment, we'll talk about it some more and kind of express concerns. But for the most part, you know, we both recognize that most of what we're investing in is very risky. It's kind of what I said. It's like, yeah, we think maybe for a lot of the investments we do, it's like a 1 or 10% chance of a huge return. Most likely it won't work out. We're both wrong on both sides all the time. And so we've really taken the approach of, hey, let's build a big portfolio of the best companies we can find. A lot of them won't work out, and that's fine. But the way we've been doing it, we keep getting lucky enough every year with enough good companies that our returns look good. And so that autonomous decision making, where he has full freedom of judgment, I do too, is good for building these like super diversified, super high beta portfolios that we're really going for, if that makes sense. I think if we were doing just 2 or 3 investments a year, we'd be very fearful of getting something wrong. We'd probably argue a lot, be like, no, you can't make that investment, it's too risky. But because we're embracing the risk and really just want exposure to as many of these super high potential but very high beta investments as possible, we're both happy to just run and like get as many of these as we can.
It's really a hyper differentiated strategy compared to most VC funds that are becoming more insular. It seems the trend is going from being sector and stage agnostic to becoming a real sector specialist and relying on deep technical knowledge to invest only in a certain area, which is also what LPs seem to prefer to manage their overall risk to the asset class in general. Where do you think Unpopular might be within 5 years? Do you have any goals to build the rolling fund into a more formal entity? Or is it working so well that you wouldn't change anything? You want to keep doing what you're doing?
Well, it's funny. So we're really happy with what we're doing and how it's working. I feel like we're getting enough money to make all the investments we want to do. We're very happy with our economics. A few bigger LPs had in the past expressed interest in investing in a conventional fund if we raise a bigger one. And in the past, we had said to them, oh, well, we have a rolling fund. Why don't you invest in that? And the response was always kind of like, oh, that's cute. Let us know when you have a real fund. And so earlier this year, we decided to go out and test the waters. We created a deck, said, okay, we'll raise this conventional fund, 50 million. Approached those LPs, and we said, hey, okay, we're going to do this real fund. Do you want to do it? Do you want to be in on it now? And we got just a ton of pushback. A lot of them really don't like our strategy. They don't like how many investments we do. A ton of them either don't like that we invest internationally or are actually barred from investing in VCs that invest meaningfully outside the US, which is a huge surprise to me. That was one of California's biggest pension funds told me flat out. They're like, sorry, we can't invest in you because you invest outside the US. Or a lot.
Why,
It's okay if you do 1 or 2, you can't do something.
why would that be the case? The endowment stipulations or tax reasons, or it's just someone somewhere in a bureau, in an office somewhere has decided that that's the rule that they should follow?
It kind of goes back to what I was sharing earlier, how a lot of VCs, so there's at the VC level, the VCs kind of create these arbitrary boundaries about what they are allowed to invest in or not. But it's also heavily dictated by the LPs. So the LPs will say, okay, we're going to invest in VCs that maybe have a concentrated portfolio strategy of 20 to 40 investments. All the GPs are in the US. They mostly invest in the US. They mostly invest in tech. Or it's like they create these rules and it then cascades down to what the VCs will invest in. And so anyway, we found we're very unpopular with the big LPs. And it's taking meeting after meeting, and they kept kind of having these like really silly reasons to not invest. And it was crazy too, because every single one acknowledged, like, they're like, wow, your returns are amazing. They're the best. They're among the best we've seen. That looks great. But oh, wait, you do 100 something investments a year? Oh, no, we can't invest in that. Or, oh, like, whoa, wait, why are you investing in outside the US? The best companies are in the US. And it's like, we don't think so. And so anyway, they had all these reasons to say no. And it just got to this point where we're like, you know what? We have a system that's working. We're investing 10 to 20 million a year with what we do. Why would we bend over backwards to get this LP money? And then the funniest insight at the end of all this is that the actual returns of the overall VC industry are really not very good. It seems that these boundaries that LPs have decided are kind of the right ways to do VC and what they're going to allocate to produce really pretty abysmal returns. There are all these different kind of charts and statistics, but it's like in conventional VC, it's very, very rare to have even a 3x, which isn't even that good. But it's something like between, I think, 5 and 12% of VC funds produce a 3x to the LPs, which is surprisingly bad. And what we realize is we have a strategy that we think is working really well. It makes a lot of money for us and our LPs who want to invest in us. Why would we change that? And the decision is kind of like, we can either do what we think is right and make it great returns, or change it to fit inside the box of these LPs and end up with worse returns, but kind of get that money and have the management fees. And if that's the choice we can make, do we want to get the fat management fees, or do we want to actually make good investments and earn our money through the performance fees? Of course, we'd choose the latter. So we basically abandoned the bigger fund. We're very fortunate and very grateful that to the LPs that we do have, they believe in us and believe in the strategy that we're pursuing. And those are the people that we want to work with.
Wow. I mean, I think it's actually a strength in the end of the day because it will limit your competition. You've built a huge rolling fund and syndicate. For others to try and replicate that success now, it's much harder. And you're playing in a field that other people can't compete. So you've mentioned a few times on the call that you're very rarely priced out of a deal. In fact, valuations are more attractive than they would be in other places because there aren't too many investors competing on the deals, which is exactly what you want in the venture space, to create outsized returns. This has been an incredible episode. I appreciate we're running out of time. Thank you so much for sharing all these insights and stories with us. Wow, you had an incredible career. I wish you the best of luck at Unpopular. For everyone that wants to get involved, I'll drop the links in the description below to the